We're going to take a look at the markets as we usually do. Fortunately, there's not too much activity. We are, however, seeing some action in the so from this watch list. GBP is down a bit. Dollar yen is down with about points. What else? Crude oil is up with 31 basis points, but it's not a lot. It's just 18 cents, which is not too much. And then you're having a bit of stock markets up, but not by a large amount. So a tiny bit of risk on. And I think the only thing that sticks out here is the GBP. So let's begin with the pound versus the USD. So in the pound versus the dollar, we talked about the market moving upwards, and then from pretty much this level here, which is the um, at 2134 level, the idea was for the market to roll over. So it reached these levels, and then it went down out of that move, out of that range, and then moved back up again. And then early in the morning here, it started out at 7 a.m. by selling off and going lower. Usually when the market starts to trade lower like it does like this in the early morning, it will usually continue to dominate the price action. And we're pretty much now at my first short-term target, which is 27.8, just that level here. And selling will probably continue until US joins in a few hours time. That means that we could potentially reach something like 20.53, and then from these levels, maybe the market might go up again, and then we'll see what happens. Because we need to be realistic here. Nothing has happened since August 1st, and it's the holiday period. I think for another 2 more weeks, another 1.5, another 2 weeks, 2.5 weeks really. People are going to be away. So I think maybe from the second week of September, I think at that point the market will more people are going to come back. Now, just because people come back doesn't mean that we're going to have strong trends immediately. What's more likely, people are going to sort of look, see what's happening, and then you have some sort of break, either bullish or bearish in most markets, and then people are going to try to push, and we can probably see a trend for a few days. So no change to the outlook here. I continue to be bearish, and I continue to anticipate this to go lower. Um, and that's it really. I received a few questions about this as well. Um, and the question was, if I thought the market was going to head higher, because I talked about two scenarios lately. And one is the longer term scenario where I prefer to short sell between 23 and 124. And then there's this short term. The problem is we never know for certain which one is going to kick in, right? Sometimes if you wait for that corrective or bigger pullback, you never have that correction, and then you just miss out. On the other hand, these short-term setups are more fragile. Unfortunately, though, I don't have like a crystal ball or any way sort of have an idea exactly what's going to happen in the future. So what I do is I just make choices, right? Sometimes I trade these short-term setups, sometimes I don't. It depends on the market situation. And today, with that high, also with that low volatility, and people on holiday, more short-term setups are less good, because the market will sometimes spike above the resistance levels without actually, uh, you know, um, looking to break the levels. So technically, it could have gone up, spike above, and then go lower. Now this is your euro versus the USD. So last week we talked about traders are probably gonna try to short sell around these levels. We're dealing with what we call Andrew's pitchfork, which I'm investigating. I haven't really used them at all for too long. I mean, I just sort of picked them up. I'm not sure actually how I actually picked them up, but I picked them up just recently, and I've gone through a bunch of different charts here, and it's quite interesting. And these low volatility environment, when the market sort of slowly and slowly goes down, it seems at least that it seems to make sense. And we talked about here this potentially going down, which it did, and we're now at the median line. The median line is what's supposed to be sort of the midpoint of this downtrend. Now the market is just above the low here, and you don't want to be buying at a downtrend, because this is a downtrend. As well, do you want to be selling here? Probably not. Why? Because if you sell here, you're not going to have a good risk reward ratio. So we need to wait for a corrective move to 112.40, 112.24, and then maybe from these levels trade lower and sort of have stops maybe above 12.94 up here. So let it go up and then down. If you're still short, I would probably book half of the position, if not all of it. And if you don't book half, maybe one can keep it full for the move here. Dollar versus the yen then. So what's going on here? So it's pretty much like where the GBP was a few days ago, right? So this market is holding up relatively well and it's at to sell some, but sort of refuses to move away. Why? Well, stock markets are rather bullish. So people are buying stocks and this is sort of tagging along to some extent. But, you know, technically there's nothing wrong here. Risk-reward ratio is 2.24. So I'm going to stick with this one. Again, it's just a choice, you know. There's nothing wrong. You know, you can trade with this one. And we'll see how it goes. Because trading in general, there are different ways of trading, right? So you have the more traditional sort of long-term investment, which is, you know, you invest in certain things. Usually it's not for Forex, by the way, but it's, say you invest in some companies, like you think you found the new Google or the new Facebook, you know, you would put 10% of your money there and 10% of your money in the other company, and then you find like 8 other similar ideas, and then you just hold that, and then like 3 years later or 4 years later, you know, you sell. That's sort of longer term investment. But what we're doing here is not like that. Here, in what I do is I'm trying to trade with the trend, and I try to bring up my frequency. So I trade maybe 120 times per year, 140. And I had no idea in the beginning of the year which of these 140 trades are going to work out. Not at all. But the idea is that I trade, and some of these 140 trades, maybe 20 of them are going to be able to produce some very good gains. The other ones are maybe going to be small gains and small losses. And then by the end of the year, I trade 140 times and I have some profit. So I don't really know exactly which is gonna work out, but I can do this. I can make sure I trade with the trend, and I can make sure I trade from a level where the risk-reward ratio is good. I also make sure that I don't risk too much per any individual trade, because if I do that, you know, I won't have enough money. So when I'm supposed to trade my 140th time, if I don't have money left, then I'm not allowed to play. It's much like a casino, for example. At a casino, the house lets everyone play, right? And it's a bit different though, because the casino is a bit like scalping. So what they do is that they let everybody play. They make a little bit of money on each bet that people do, and then once in a while they need to pay a big profit to the to whoever wins. But the idea is that you collect enough profit from all of these different people, so when you do that payout, you don't have to. You'll still make money at the end of the day, much like an insurance company. Here's a little bit the other way around. We play a lot of small games, and we have a ton of small losses, and then once in a while we have that big profit. Obviously, there's a big difference between casinos and this. When you trade to begin with, you have a 50-50 chance of making money, right? In the casino, the numbers are, or the rules for the games are set up so you start out with less than a 50% chance of winning. Okay, let's move along here, and we'll take a look at gold prices. So this is gold. So here again, it's a choice of, do you think we're going to, you know, see slower stock markets and you don't want to wait for that strong pullback? Then this was the spot. We talked about the spot yesterday and buying here, and the market is now moving away. From a short-term perspective, if we hit the high, you have a decent risk-reward ratio, and that could potentially be it. On the other hand, if you're waiting for a steep pullback, then you will look for this move to go, or the price to go down to 1460 before turning bullish. Crude oil prices is very, very easy. This market is just trading sideways. No one really knows exactly what's going to happen. And we talked about this for more than a month now. Just wait for this to trade even more, and the range to become more and more narrow, and then eventually we have a breakout. German DAX is trying to move upwards, but is struggling. It's not a surprise, and the reason why it's not a surprise, because if you look at the daily chart, you can see that the market is clearly moving lower, and I think we can go down to maybe 11,250 or something. And I'm just gonna stick with this bearish view. So there's no change to the outlook. As for the S&P 500, it's also sort of just above these highs. It can, of course, break a higher and take out something like 29.41, but we need probably some economic data pushing price upwards, forcing people to get out, because this is where people sold in the past. So this is a sell zone. So we don't want to be buying here. If you want to buy, you should be buying down here. Okay, let's see if you guys have any questions or some good morning. So we have Stefan here today. Good morning to you, sir. Hope you're doing well. And we have Kirsten couple. Well, the Kirsten couple. Has the live video started? It says 5 people waiting. Thanks, the video's up. Yeah, sorry about that. I don't know if you noticed, but I'm in a different setting today, so the camera had some issues with it. Dollar CAD had been stuck sideways for 4 years. Do you think a break below 120 or about 136 can come before the end of the year? Let's take a look at it. So, did you actually say 120? I think you did say 120. Yeah. So 120 here. And you said 136. I think you said right. 136. So one way we can sort of have a rough idea if this is going to happen, we can add what we call the pivot point indicator. We can change it to the yearly one. So these are your yearly pivot points. So 82% of the time, the market will be trading within R2 and S2. So it's definitely feasible that we're going to reach either 46 or 117. That's like an 80% likelihood. That is based on the idea that on a daily time frame, the likelihood that we stay within R2 and S2 is 80. So I'm just using the same figures and sort of assuming that they're gonna last for the yearly one as well. Now 120 right now, it feels a bit, I mean, it's difficult to say if we're gonna reach that level at all. I think if we revisit something like 130, take that out, then that could, send you down to 125, maybe 120. And what could trigger that? Well, what's quite interesting is that the Canadian central bank is far more hawkish than the US central bank. They're not at all looking to cut, at least that has been the norm lately. They should eventually start to cut though. So that could be something that could trigger a break. Now you talk about 136, but I would suggest that you look at something like 136.78. I think that's more relevant, and if you're looking from that perspective, this almost looks like inverse head and shoulders with head, left, and right shoulder. So a break to the upside of this level here. Well, this is the actual neckline, but the break to 36.78 is more likely. So I think this could make sense, because usually when you have economic slowdown and risk off, crude oil tends to decline, and smaller currencies like the Canadian dollar tends to weaken. So this would not surprise me On the other hand, you have that macro fundamental backdrop that is driving things and suggesting that we could probably trade a lower. So yeah, I think, can we break these levels? Yeah, we could. We haven't done this year, but soon, I think very soon, something's gonna happen. This is, as you know, the Euro USD. So this is your average true range. And if you look at the average true range, we're currently at something like the average weekly range, 14 weekly range is at 14 week range is at 127 points. And last time we saw this, actually it's here, was in February 25th, 1985. And these sort of low volatility conditions don't hold forever. As well, if you go, we can go to the New York Fed. The New York Fed recession probability. So everybody talks about the inverted yield curve. So what the New York Fed has done is that they take this yield curve, which is now at the negative 8 basis points, difference between 10-year government bond yield and 3-month treasury bill. You can see that when it's getting negative, you tend to have a recession at one point, but it tends to happen when the yield curve goes upwards. I've been saying this for a year. I think we talked about this already like 2 years ago, but people don't go beyond the headlines, unfortunately. They just go to Zero Hedge, and then Zero Hedge puts out a bearish article, or somebody else says something bearish. And the problem is, if you pay attention to the patterns, some people are always bearish, and then you have some people that are always optimistic, and then you have people that try to be somewhere in the middle. I try to be in the middle and just work with numbers rather than just scaring people. Anyway, you see, we've gone down here. We need to start to move upwards. Why do we need to start to move upwards? Because what the Fed needs to do is they need to start cutting interest rates, and that's gonna tilt the yield curve. Anyway, we need to go up first, and at that point, I guess that's gonna happen. Now, looking just at a chart like this, you know, we don't know exactly what this actually means. But what the New York Fed has done is that they have actually put a number to it. So they mathematically look at the correlation between the yield curve and recessions. And then you get this. So the likelihood of getting a recession in July 2020 is 31.47%. And you can see that in the past, it's not 100% correctly, because this exact model, you can see it uses data from 89 until December 2009. So it always gets re-estimated. But I guess there's some truth to the following, and that is that if you look here, the probability of recession went to 40%, here went to 45, here went to 33 or something like that. Then it went to 40, here went to 65, and here's almost 100. And here is, well, actually, this is interesting. It's coming afterwards, but this is, well, 29, 28. So this indicator by itself, sorry about that. The indicator by itself does not have to go up to 100% before it would indicate a recession. And again, because it's been re-estimated, we don't know exactly how it would have looked in the past. But again, there's the truth is somewhere in the middle, I would guess. If we can find old setups or old saved files like this one, maybe it would have been something similar, I would guess. And why do we care about this then? Well, because what we're dealing with right now in US stock markets, and what we're dealing with in something like the euro dollar, is just the calm before the storm. And at one point, the market will just make up its mind. We're in a recession, and then all these little cute ranges we're working with in the euro dollar and in the dollar CAD and so on and so on, are just gonna be blown out of the water, and we'll have some decent trends to work with, which is what we need as traders. So here, for example, to give you an idea, the stock market reached a high in 07, in February 07, and then it traded sideways for pretty much like a year to some extent. It went up, down, and then here it properly sort of failed. It declined lower and sort of failed to regain, and then you had that big decline. Yeah, and here when we had this situation here in 2015, 2016, we had a very similar situation, and this is the way the S&P looks like today. And we had that slide, what a lot of people said was probably going to be the beginning of something, but then we went all the way up. If this would have failed to trade lower and just gone down, and then there would have been a proper bear market. Now, of course, we're dealing still with what looks to be like some sort of a bullish market. We are just 3.34% away from the all-time high. Maybe we'll break the upside. You got double right shoulder, big left shoulder, double left and a head. So we could, at least according to the technicals, still have that break there. And we need to be open-minded here. So why would this be different now than before? Well, because you have central banks that are far more interested to manage the money and manage the economy in a different way, right? So they're looking to support the economy by cutting interest rates. You have Lagarde that's going to take over from Mario Draghi. She, about 6 months or so before the ECB themselves sort of decided that they wanted to do quantitative easing last time around, she was already advocating it. So it's quite likely you're going to have someone like the central banks looking to support the economy. So maybe we'll never have a crash, and maybe we'll be in a dull market forever. I truly don't hope so. So what can you do as a trader? Well, you can wait, and you can just analyze a bunch of markets. Like I look at probably about 100 different markets, just like different crosses, like dollar Hungarian forint, Taiwanese stock market index, platinum, Swedish stock markets. I look at a bunch of different things, and then I just try to see how things, if it makes sense to trade them. And right now, unfortunately, there's nothing here that makes me super interested to trade. Okay. Hello, Nikos, and good morning, Marvin. I hope you guys doing well. Okay, I think we're going to wrap things up. We don't have any more questions. I hope that helped a bit with your trading. If you have any questions for me during the day, you're most welcome to reach out. I won't be able to tell you, though, like if you're short and you're in a massive loss, or you're long and you're in a massive loss, I can just share with you my view on the markets, but I won't be able to tell you how to manage your trade. I can just tell you, okay, we're in a downtrend. These are the support levels, and I can tell you what I would have done, but I can't tell you what you should do. The best thing to do is to actually not get into problems from the beginning. And how do you don't do that? Well, if you want to buy something, for example, at 100, and you do your technical analysis, and you think you need to have your stop loss at, say, 93. Well, if your position goes from 100 to 93, the loss there in your capital should not equal more than, say, 1.5%, 2% of your capital. The problem is, though, that people, they buy it at 100 and they have no stop loss, and they buy oversized. So the market goes from 100 to 95, and they're down with about 20% of their account. And then they don't know what to do, so they hold it for longer, and then it's down at 90, and they lost even more. They're down with 40% of their capital, and then they come and say, oh, what should I do? At that point, you can still salvage an account that is down with 40%. But sometimes when the account is down with 75, 80, then you might as well just keep it up. Unless, of course, it's a significant amount of money, and it really money that you can use And that brings us to a final little tip, and that is not to trade with money you can't afford to lose. I personally think it's perfectly fine to put, a few months, if not a years of salaries into an account, savings and things like that. But you don't want to sort of put all your savings, your pensions and stuff like that. So if you lose it, you're gonna be in serious trouble. Because when you start to trade with high numbers, unless you are like very emotionally stable and like almost like very sort of thick skin, what happens is that when you start to bet with high money, then the money that you cannot afford to lose, your brain doesn't work as it should do. You're not thinking normally, and what happens is that people will you will in essence just make mistakes, and you don't want to be in that position. Okay, guys, we're gonna wrap things up. Guys, thanks so much for watching, and I'll see you guys tomorrow, same time here at Investing Cube and ATFX channel. Thank you so much, and see you guys tomorrow. Bye bye.